With inflation in check and growth indicators mixed, the Monetary Policy Committee is widely expected to cut its benchmark repo rate by another 25 basis points this week. The question is whether growth conditions warrant a steeper cut or at least a change in stance back to being accommodative. Joining us to talk about policy expectations is Rajeev Malik, founder and managing director of Macro Shanti. He's joining us from Singapore. Rajeev, thanks so much for joining us. Appreciate you taking the time. I am going to start with first the very basic expectations. I think you were among the first to say that we will have two consecutive cuts in February and in April. Is policy and data playing out to expectations?
I'd say even more, a bit more aggressive. So I actually think, while you rightly highlighted that a quarter percentage point is pretty much a done deal, I think there's a strong case for the MPC to review and go in for a bigger 50 basis point cut, even if it doesn't necessarily want to change the stance. To me, there is no inconsistency between that action and the action on the change in stance. I think analyst MPC itself has been slow in adjusting to the change, both globally and domestically, be it on inflation or as far as growth indications are concerned. So I do think it needs to redeem itself for having had a slow start off the block and to come out with a deeper cut.
Rajeev, let me start getting into the data points then. I think there is still a debate, at least domestically, as to how deep the slowdown is. A bunch of indicators coming out, some suggesting, for instance, the auto sales, that there is some sluggishness in demand, although this morning Bloomberg Quint had spoken to the Maruti management and they said that they expect demand to perhaps pick up post-elections. Other indicators like PMI are actually showing consistent strength. What do we focus on to then justify a deeper cut at this stage?
Well, first off, much as there's a lot of scrutiny as far as India's PMI survey is concerned, quite frankly, I've never found it as a leading indicator of any activity indicator. Don't forget, it's a survey that tells you about sequential momentum as far as expectations are concerned for the purchasing managers. But really, to find out how good it is or relevant it is, you have to link it to some kind of real sector activity indicators, be it GDP, be it IP, be it manufacturing output. Quite frankly, in India's case, it doesn't really sync with anything. So much as people play up how well PMI is doing, and it's been doing that for quite some time, that has not separated actual growth momentum to slow down to what, 6.6%, a 5-quarter low. Even if you discount for the base effects, etc., there is a slowdown. I admit, as you rightly said, indicators are still mixed, but compared to 2 months ago, when the MPC minutes themselves indicated some loss in momentum emerging, I think over that time period, we've only seen more consistent deterioration, most importantly from the global sector. So much as at a time when domestic indicators are mixed to slowing, you're going to get a sting from the external side, which is going to have its adverse impact as well as far as growth momentum is concerned. So, people are looking that FY19 would have ended with a 7% growth, full year average could be a touch lower. RBI's expectations of a 7.4 for FY19 and 20 seems rather optimistic in my view. They will have to go ahead and cut it. And at a time when inflation, at least on a one-year outlook basis, seems pretty well behaved or benign, there is no reason why not to go ahead with a bigger cut.
Rajeev, it has also been argued, so if you, for instance, look at core inflation as an indicator of demand, so there is a segment of economists which is arguing that if there was that much slack in the economy, you would have started to see core inflation come off. The fact that core has remained between 5.5 to 6 perhaps suggests that there isn't that much slack, and hence there isn't that much scope to either provide monetary or fiscal stimulus to the economy. What would you say to that argument?
One of the oversights, and all of us are taught in terms of core inflation indicating underlying demand momentum, etc. But bear in mind what exactly is driving core inflation in India, and how much of it is really cyclical demand aspects. I mean, are they the ones that necessarily impacting what's happening to education and healthcare costs, or are they heavily, impacted as well by some of the policy measures that have resulted in one-off adjustment in prices? which will gradually dissipate overall. So my sense remains, I think we've seen the best of the low food inflation behind us now. As February numbers indicated, the pace of decline in food inflation is coming off. We will move into slight positive territory. So the headline number will clearly move slightly higher, but on a one-year outlook, it'll still be well behaved to be slightly below or at 4% as far as RBI's target is concerned. That gives it the flexibility in an inflation targeting framework a central bank needs.
And probably the window, right? I mean, I think 3 months down the line, like, as you were saying, the headline number would have started to move up. At that point, to justify rate cuts may be far tougher. They may have already lost some time over the period when inflation was low and, came in below their expectations. So, maybe this is the window they have.
Well, exactly. I mean, I really don't find the merit in an MPC that was slow off the block, now cutting by 0.25 percentage point, and then perhaps cutting again in 2 months' time. I mean, is the inflation outlook going to be dramatically different from now through June? I certainly don't think so. At the June meeting, they would not have any additional clarity in terms of actual outcome as far as the monsoon is concerned. And I don't quite think the MPC has enough confidence to shift its stance to easing without really having enough clarity as far as the monsoon outcome is concerned. I know there'll be a lot of resistance about a 50 basis point cut while the stance is still neutral, but quite frankly, I actually don't know of any central bank rule book that says that would be inconsistent. Don't forget, the quantum of cut is dictated by the need, availability of space, and signal as far as urgency is concerned. That is a different decision from what the central bank wants to communicate in terms of how many rate cuts potentially in terms of easing could be there. Nobody will give you a number, but just by indicating the stance is easier, they clearly would be indicating several rate cuts. I actually don't think the MPC can have the confidence to give that signal just yet.
Okay, so, the theoretical debate, at least domestically, is that the MPC just hasn't figured out or got their act right on this stance issue. They were hiking rates when they were neutral. They went into calibrated tightening, and the next move was a cut. Now they are on neutral. They cut more, and, you're saying that perhaps that doesn't indicate anything about future action at all.
No, I mean, I'll actually defend the MPC on that particular guidance. Don't forget, it is relatively common for central banks to come out with 1 or 2 rate moves, even if they are on a neutral stance. That is precisely what a neutral stance gives them, the flexibility to move either way. Now, it just so happened, and I think here we have to be somewhat sympathetic, and I think most private sector or public sector forecasters forget about their own experience, and central bank is always an easy target. I think given how quickly global dynamics have flip-flopped, the MPC should have stepped up and changed its stance earlier. Maybe they were caught in that typical element that, look, we just changed stance at the last meeting, how can we quickly reverse it now? That could possibly one potential argument. But I think we can't keep waiting for all this to play out. My argument for a 50 basis point is pretty simple. The inflation outlook gives you the flexibility. Growth momentum slowing down certainly requires it. And at the same time, rather than doing 2 25 basis point cuts now and 2 months later, why not just go with a 50 basis point, even if you actually remain, keep the stance on neutral? You then revisit after the monsoon to see whether or not how much confidence you have that whether you can signal an easing stance at all.
Okay. Rajeev, just picking up on what you mentioned at the start in terms of what's coming through from the global economy. Again, you're fairly convinced that there is a slowdown impending in the US and the Eurozone. China data today gave a bit of optimism, but the earlier expectation was that China will be soft as well. That and the change in monetary policy stance globally is a relevant input into our policy decision?
I think big time. I think people are overlooking what the MPC's minutes, RBI's MPC minutes emphasized as far as the loss in growth momentum and especially concerns about the global backdrop are concerned. So I don't think the rate cut in February was only because inflation has been well behaved. It was accentuated partly also because of concerns on the growth front, which I think since that time have only accentuated or strengthened in terms of slower global demand dynamics.
Rajeev, a couple of other questions, away from immediate policy issues. But there's a problem with the liquidity situation in India once again. After the first rate cut, we haven't actually seen any decline in rates either in the bond markets and certainly not on the bank side. Actually, bank rates have risen. And everyone is blaming that on the RBI's liquidity stance. So they cut rates, but they've kept liquidity in deficit. And the argument is back to the 2015-16 argument that if you're cutting rates, then liquidity should be surplus for it to transmit. Your thoughts?
Well, it doesn't necessarily need to be surplus, but I would argue, don't forget, if the stance is neutral, there's no reason why the liquidity setting should be tighter. So don't forget, if you go back to Raghuram Rajan's days, and there was a similar issue at that time with liquidity, with the central bank thinking that the weighted average call rate, as long as it is close to the policy rate, that is a good indication in terms of liquidity being well behaved. But there was, of course, a difference in terms of the durable component and the non-durable component of that liquidity. We're in a very similar situation now, obviously with certain other factors such as currency in circulation spiking because of elections, etc. All of that has complicated the situation further. So quite frankly, one of the easy steps the central bank could actually take is once again reassure about liquidity, but also indicate that it will keep liquidity in neutral rather than even a slight deficit. I think that certainly is worth exploring because it should have a fairly meaningful impact as well.
But in the early part of next financial year, or this current financial year actually, you will in any case go towards neutral liquidity. I would assume that problem would get resolved at least in the first quarter. But you're saying the messaging that in this cycle we intend to maintain neutral liquidity would be important to the market?
Well, communication is where all of the effectiveness actually comes down to. And I don't expect anything on liquidity as far as the policy statement is concerned, because don't forget, MPC's domain is really with the policy rate. But I do think in the Q&A, these issues are going to come up, and either the governor or Deputy Governor Acharya, I think, will go out of their way to reassure and clarify some of these things. Otherwise, it's just, it's only complicating and undermining whatever they're trying to do with cutting interest rates.
But tell me, for instance, if you look at what happened last year, Rajeev, and what will happen this year as well, when the government borrowings are really high, that shouldn't guide the RBI's liquidity stance, right? I mean, because then it's sort of adverse incentive for the government not to behave fiscally. So that cannot guide they have to look at the durable liquidity side and say that this is what is guiding our liquidity injections, and not just the fact that yields are high or, government is sucking out too much of the savings.
That's absolutely true. But, bear in mind, and this is always the case, and it's been shown repeatedly, when push comes to shove, RBI is the one that will have to show some flexibility. Because government as the biggest borrower is also the least price sensitive. It also has to deal with a lot of the stuff that the banks are saying that, look, we can't expand our loan books because of tighter liquidity conditions or that interest rates are high. That's, straight away goes back to the RBI once again. So I think we're in a bit of a, between the devil and the deep blue sea kind of a mentality. But I think every time push comes to shove, it is always RBI that has to come in and show a bit more flexibility. Don't forget, you have public sector banks where the whole asset liability management is really on God's grace rather than any meaningful momentum. Once again, RBI has to step up.
Okay. Rajeev, just sort of coming back to the outlook for the economy, as things stand, you would expect FY20 to be a year in which inflation normalizes perhaps at least back towards the 4 to 4.5% range. People are projecting an average inflation rate of about 4.5% for FY20, and growth stays close to, 7.3%?
I would think so. I mean, I'm still not a big fan that even if growth is close to 7% or slightly shy in FY19, that we're going to see any meaningful acceleration. At best, 7.1, 7.2 for FY20. Don't forget, second half of any fiscal year is always bright in India. At least at the beginning of that fiscal year. We've seen that on the earnings momentum as well for several years in a row. And in terms of macro growth forecast, it's not any different exercise as such. But I think I've always described India as a truck with a messed up gearbox. And I think all these years we've been going around and, painting the truck, changing tires, fueling it up and everything. But the gearbox is still stuck. And you really aren't going to get any revving up as far as the engine is concerned till that is fixed. And that is still going to be a slow, drawn-out affair. At a time when increasingly now the global backdrop is going to be less conducive. The only good thing there is India is not as export-intensive as some of its Asian neighbors. But let's not forget, over the last 20-odd years, it has actually become a lot more export-oriented. So the domino impact is still going to be felt.
Fair point, Rajeev, but if you look at a 7% growth rate and a 4% inflation or 4.5% inflation rate, that's not a bad growth inflation mix. That's pretty much perhaps the best that we've had.
Well, I mean, it depends on what your reference point is as far as growth is concerned. Are you going to be just satisfied, plain vanilla, with a 7% growth rate? I mean, you and I might think that that is not a bad outcome, but do the political masters necessarily think that and are content with that number in an aspirational voter base? That becomes the big question. I'm distinctly reminded post the global financial crisis when India had come out with this massive fiscal stimulus, which complemented a monetary stimulus and was actually late in pulling back the fiscal lever. One of the arguments was about getting to the 8% growth rate, right? So that mentality always keeps coming back to haunt us in some shape or form. And you really can't change trend growth rates just by a fiscal stimulus or by cutting interest rates. There has to be something more substantial from a reform front that actually changes the long-term potential growth and realizes it.
We'll see what the new government has in store. So far, it's largely been promises on, income support programs and farm support programs. Last question, Rajeev, though. The foreign investor community is looking at India quite favorably right now. A ton of inflows coming in March, both equities and bonds picking up as well. You expect that story to continue, or is there also an election element, at least into the equity side there?
I think there is an election element, but don't forget, purely at a time when, there are great indications about the Fed being done with interest rates. And even if you don't necessarily buy the argument, as I don't, that, a recession is imminent, rate increases in the US are pretty much done. And that actually plays out well for risk assets. High yielders in Asia will certainly have a good say, and India and Indonesia have reflected that. Although I should point out, between the two, the election campaign rhetoric in Indonesia seems to be so much more constructive than what's going on in India.
All right, Rajeev, I'll leave it there. Your call, 50 basis point cut, can be on the table. We'll see how it plays out later this week. That's Rajeev Malik with his thoughts on the MPC meeting that's coming out this week, and of course the macro environment in India. Thanks so much for watching Bloomberg Point.